Welcome to Aviation Intelligence Weekly with Sarah and Mike, your guide to the aviation industry. Welcome to Aviation Intelligence Weekly. I'm Sarah, and joining me as always is Mike, our defense and aerospace markets analyst. Today, we're digging into L3Harris Technologies, ticker LHX, and their 10Q filing for the second quarter of 2026, filed on July 30th. This is a company that sits at the intersection of defense electronics, mission systems, and government contracting, so there's a lot to unpack. Mike, let's get into it.
Thanks, Sarah. And before we dive into the numbers, I want to set the analytical frame for listeners who may be newer to defense primes. L3Harris is not an airline. It's not a pure aviation play. It is fundamentally a government contract business, one where revenue recognition, margin, and cash flow are all shaped by the rhythm of congressional appropriations, contract types, and program execution. Keep that in mind as we work through this filing.
So let's start with the core thesis. If you had to reduce this filing to one sentence, what is it?
If we reduce this filing to one sentence, it's this. L3Harris is generating substantial top-line revenue and operating income at scale, but the filing's MD&A excerpt is so procedurally thin that management has effectively told us nothing about how they got there or where they're going. Based on this filing, L3Harris Technologies is operating in what I'd classify as mid-cycle expansion. Revenue is large, margins appear healthy on the surface, but the absence of substantive management commentary creates a visibility gap that investors should not ignore.
That's a sharp framing. Let's hold that thesis and test it as we go. Now, the filing notes this is the first filing in our system, so we don't have a prior quarter to compare against directly. But we do have the headline numbers. Walk us through what changed, or at least what the numbers tell us.
Right. So let's be precise about what we're working with. The filing reports revenue of $6.18 billion for the second quarter of 2026. To put that in context, and this is background rather than anything in this filing, L3Harris has run in the roughly $12 to $20 billion annual revenue range since the 2019 merger of L3 Technologies and Harris Corporation, so a $6 billion plus quarter is consistent with a company running at full operational tempo. Operating income came in at $1.31 billion, which implies an operating margin of roughly 21%. Sarah, that is a strong number for a defense prime.
How does that compare to what we'd expect from a company in this space?
Sector context first, and I want to flag that this is outside knowledge rather than filing data. Defense prime operating margins have historically clustered in the 10 to 14% range for large diversified contractors. A 21% operating margin, if that's what the math shows here, would be at the high end of what this sector typically produces. Now, I want to be careful. The filing does not break out segment-level margins in the excerpt we have, so we cannot confirm whether that blended margin is being driven by one high-performing segment or whether it's broad-based. But the top-line math is notable. Net income came in at $1.11 billion, which implies a net margin of approximately 18%. Again, that's above the historical norm for this sector.
So the headline numbers look strong, but you mentioned the MD&A excerpt is thin. Let's talk about what management actually said, because that's where the real signal usually lives.
This is where I have to be direct with listeners. The MD&A excerpt provided in this filing is, in the words of the filing summary itself, largely procedural and administrative in nature. What we have is the tail end of the MD&A, the boilerplate compliance section. Management's actual discussion of revenue drivers, program performance, backlog, and forward outlook is referenced but not reproduced in the excerpt we're analyzing. The filing does state, and I'm quoting directly here, results of operations in our Form 10Q for first quarter 2026, which is incorporated herein by reference. That's a reference to prior period context, not a new disclosure.
So management is pointing back to Q1 for context rather than providing fresh Q2 narrative?
That's what the excerpt shows. And the second key management statement in the excerpt is this. Again, a direct quote. There were no material changes during second quarter 2026 with respect to our exposure to market risk. That's a narrow statement about market risk specifically, tied to the long-term debt repayment they reference elsewhere in the filing. It is not a broad operational commentary. What we can say is that management concluded, as of July 3rd, 2026, that disclosure controls and procedures were, quote, designed at a reasonable assurance level and were effective. That's a clean internal control certification. No red flags there.
Let's talk about tone for a moment. When you read what's available, what's the overall register? Cautious? Confident?
The tone is neutral to procedural. There is no language of alarm, no hedging around program performance, no escalated risk language. The statement that there were no material changes to market risk exposure is, in its own way, a quiet confidence signal. Management is not flagging new vulnerabilities. But I want to be careful not to overread silence. The absence of bad news in a boilerplate compliance section is not the same as a management team expressing operational confidence. The substantive commentary simply isn't in the excerpt we have.
Understood. Let's move to financial red flags or confirmations. You've got the balance sheet numbers. What stands out?
From a balance sheet standpoint, the number that commands attention is total debt of $6.95 billion, all of it classified as long-term. Cash and equivalents stand at $1.52 billion. So net debt, total debt minus cash, is approximately $5.43 billion. Now, let's put that in context. For a company generating $1.11 billion in net income in a single quarter, annualized, that's roughly $4.44 billion in net income. A net debt position of $5.43 billion against that earnings run rate implies a net debt to annualized net income ratio of just over 1.2 times. For a defense prime with stable government contract revenue, that is a manageable leverage position, not a stressed balance sheet.
So the debt load isn't alarming given the earnings power?
Based on the numbers in the filing, no. Defense primes typically carry net debt to EBITDA ratios in the 1 to 2 times range. Again, sector context rather than a filing disclosure. And the math here appears consistent with that. The filing also notes that long-term debt repayment occurred during Q2, which is referenced in the market risk section. That's a constructive signal. They're paying down debt, not adding to it. The causality chain here is straightforward. If earnings hold at this level and debt continues to be repaid, the balance sheet strengthens over time. The risk would be if a large fixed price contract charge or a program write-down compressed earnings in a future quarter, which would change that leverage calculus quickly.
That's a good segue into risk disclosures. What did the filing flag?
Here's where I have to be transparent with listeners. The filing data indicates no new or significantly escalated risk factors identified versus the prior filing. Now, that's a system-level assessment, and combined with the thin MD&A excerpt, it means we are working with limited risk disclosure granularity. What I can do is apply the defense prime analytical lens to the risks that are structurally present for any company in this space, because they are real, even if not newly escalated in this specific filing.
Walk us through those structural risks.
The first is fixed price contract exposure. Defense primes have been materially burned by fixed price development contracts. The most prominent recent example in the sector being Boeing's KC-46 tanker program, which generated billions in charges. That's industry background, not something disclosed in this filing. The filing does not disclose any fixed price losses or charges in Q2 2026, which is a confirmation, not a red flag, but it's a risk category investors in this space must always monitor. The second structural risk is the congressional budget environment. If Congress operates under a continuing resolution rather than a past appropriations bill, new program starts are blocked. The filing does not contain management commentary on the budget environment, so we cannot assess whether a CR is creating headwinds. That absence of commentary is itself a data point worth noting. The third risk is free cash flow conversion. Defense earnings are accrual heavy. Revenue is recognized on long-term contracts before cash is collected. The filing gives us net income of $1.11 billion, but we do not have free cash flow figures in the excerpt to confirm whether working capital is consuming or releasing cash.
That FCF conversion point is critical for defense primes. Let's stay on the balance sheet and liquidity for a moment before we get to segments.
On the liquidity side, $1.52 billion in cash needs to be put in proportion. The company is running at roughly $24 billion in annualized revenue if we extrapolate the quarterly figure. Call it a little over $2 billion of revenue a month. So that cash position represents roughly 3 weeks of revenue. That is a working cash balance, not a fortress balance sheet. Whether it's adequate depends almost entirely on the availability under any revolving credit facility. And that is the key question the filing excerpt does not answer. Defense primes typically maintain multi-billion-dollar revolving credit facilities as a liquidity backstop, though I'd flag that as sector context rather than something this filing confirms. The filing references long-term debt repayment but does not detail credit facility availability in the excerpt we have. From a capital allocation lens, the debt repayment activity in Q2 is a signal that management is prioritizing balance sheet health, which at this stage of the cycle is a rational posture.
Let's get into segments, because for a defense prime, that's where the real story lives. What can we say about L3Harris's segment performance?
This is the most significant analytical limitation of the filing excerpt we have. The substantive segment-level discussion, revenue by segment, margin by segment, backlog by segment, is in the earlier portions of the MD&A that are not reproduced in our source data. What I can tell you, and I want to be clear up front, that this is sector background rather than anything in this filing, is that L3Harris reports across several major business areas, including integrated mission systems, space and airborne systems, and communication systems. The blended operating margin of approximately 21% that we calculated from the top line numbers is, as I noted earlier, high for this sector. That could indicate that a high margin segment is carrying a disproportionate share of the earnings. But the filing excerpt does not confirm segment level margin attribution, so that remains inference, not disclosure.
So, we're working with a blended picture rather than a segment by segment breakdown.
Exactly. And for investors, that matters. A 21% blended operating margin that's driven by one high margin segment is a very different investment story than a 21% margin that's broad-based across all segments. The former creates concentration risk. The latter signals operational excellence across the portfolio. The filing excerpt does not let us distinguish between those two scenarios. What we can say is that the backlog question, total backlog, book-to-bill ratio, funded versus unfunded split, is the single most important metric for a defense prime's forward revenue visibility, and it is not addressed in the excerpt we have.
Let's bring it home. What should traders and long-term investors be monitoring going forward, and where could our thesis be wrong?
Let me start with what management has given us to watch. The filing confirms that as of July 3rd, 2026, internal controls are clean and market risk exposure is stable. The debt repayment activity signals active balance sheet management. Beyond that, the filing excerpt does not provide explicit guidance, key forward dates, or management highlighted metrics for investor focus. That's a real gap. For investors monitoring this name, the metrics I'd prioritize, drawn from the Defense Prime Analytical Framework, are these. First, the book-to-bill ratio. If orders are outpacing deliveries, the revenue pipeline is healthy. If book-to-bill drops below 1.0, that's a contraction signal. Second, free cash flow conversion relative to net income. If FCF is tracking at 80% or better of net income, the accrual earnings are real. If it's significantly below that, working capital is consuming cash, and the earnings quality story weakens. Third, any fixed price contract charges. A single large write-down can compress a quarter's earnings dramatically, and the sector history on this is well documented.
And the counter thesis. What would prove us wrong about the mid-cycle expansion framing?
Two specific scenarios would challenge the thesis. First, if the full MD&A, the portions not in our excerpt, reveals that backlog growth has stalled or that book-to-bill has fallen below 1.0 for 2 consecutive quarters, that would reframe this as a late-cycle peak rather than mid-cycle expansion. Revenue can look strong in the quarter, while the forward order book is quietly deteriorating. Second, if free cash flow for the first half of 2026 comes in significantly below the net income run rate, say FCF conversion below 60%, that would indicate working capital is absorbing cash at a rate that makes the earnings quality story less compelling than the headline net income suggests. Either of those data points would require us to revise the thesis.
And revisiting that thesis, does the full weight of what we've analyzed today confirm, weaken, or modify it?
It modifies it slightly. The headline financials, $6.18 billion in revenue, $1.31 billion in operating income, $1.11 billion in net income, manageable net leverage, are consistent with a company in mid-cycle expansion. The balance sheet is not stressed. Debt is being repaid. Internal controls are clean. But the near total absence of substantive management commentary in the MD&A excerpt means we are flying partially blind on the operational narrative. The thesis holds on the numbers, but it carries a higher than normal uncertainty band because we cannot confirm backlog health, segment margin attribution, or FCF conversion from the filing excerpt alone. From a valuation framing perspective, at these margin levels, this equity is priced like a high-quality defense prime executing well. But the market is implicitly assuming the operational narrative behind these numbers is as clean as the headline figures. If the full filing reveals cracks in backlog or cash conversion, that assumption gets tested.
Mike, that's a thorough and grounded read of a filing that gave us less to work with than we'd like. The key takeaway for our listeners: strong headline numbers, manageable balance sheet, but a substantive analytical gap where the operational narrative should be. Watch the book-to-bill, watch FCF conversion, and watch for any fixed-price contract disclosures in the full filing.
Well said. And for listeners who want to go deeper, the full 10Q is publicly available through the SEC's EDGAR system. The excerpt we analyzed today is the tail end of the MD&A. The earlier sections contain the operational substance that would either confirm or challenge everything we've discussed.
That's a wrap on our L3Harris Q2 2026 earnings analysis. A quick reminder that nothing on Aviation Intelligence Weekly constitutes investment advice. We analyze public filings to help you ask better questions. The investment decisions are yours to make. I'm Sarah, he's Mike, and we'll see you next week.
Thanks, everyone. Stay grounded in the data.